Are you still convinced not having your own business can save you a ton of money? Well, let me have my friend Courtney show you more about it. Come on.
Hey guys, Courtney here, and I want to share with you automobile deductions and help you understand that auto deductions are insanely profitable. They can seriously save you hundreds of thousands of dollars over your lifetime. And I'll share with you an example that I actually utilized last year to save about $35,000 in taxes. The automobile deductions, I want you to understand that so that you know how to get more money out of your vehicles and how to also bulletproof your records against an IRS audit. Now, there are two methods that you can use in order to claim deductions on your automobile. So most people take the mileage rate, or the what we call the standard mileage rate from the IRS, and that is the simplified method. Then there's also the actual expenses, and I'll share both of them with you, the good and bad for both. So the standard mileage rate right now is 54.5 cents per mile. That is considered to be the shortcut method at the IRS, and you can claim the mileage, but you can't claim anything else. So you can't claim gas or oil changes, repairs and maintenance, and you cannot depreciate the vehicles along the way. Now, let's say that you have 15,000 miles. Those 15,000 miles at 54.5 cents per mile is $8,175 in a deduction. You may think that's a lot, and that used to be the best method to go with if you had a vehicle prior to the new tax laws. And the new tax laws came out January 1st, 2018, and what they did is they allowed you to take advantage faster of deductions for actual expenses. So actual expenses, we first have to determine what the business use percentage is. So how we calculate that is we take the business mileage, we divide it by the total mileage, and that becomes the business percentage. So if we had 8,000 miles for business, we had a total miles of 10,000, 80% of that number, 80% of whatever your expenses are, would be used for business purposes and would be a tax deduction for you. So actual expenses are things like gas, oil changes, repairs and maintenance. You can write off supplies, car washes. You can also write off interest on your vehicle. So these can add up drastically. So let's say we had $12,000 in actual expenses. 80% of that would be $9,600 that you would be entitled to take. And now that's not all, because you actually get to also depreciate the car. So depreciation rates changed significantly in 2008. And what used to take 18 years to write off a $50,000 luxury car, now it takes 5.3 years. So they've increased the depreciation that was allowed by 3 times, by a multiple of 3 times. But here's the thing, you don't have to buy a new car. The car could be just new to you, so you'd get the same exact benefits. And if you have a vehicle that's over 6,000 pounds, you can actually take even bigger advantages of it. You can take 100% of that vehicle in the year that you buy it. So let's talk about the difference in depreciation. I want to share with you an example of some vehicles that we actually purchased. So in 2017, December 2017, we bought 2 new cars. We bought a Suburban and we bought a BMW. The Suburban was over 6,000 gross vehicle weight, so we were able to write off 100% of that vehicle in the first year that we bought it. The BMW, however, was not. And so what we were able to be entitled to is a $11,000 tax deduction the first year, and it dropped considerably to $5,000 the year of 2018, and then it dropped again to $3,000 the year of 2019. So we decided in 2019 that we were going to go ahead and buy 2 new vehicles. And because of that, one of those vehicles happened to be another Suburban. So that was a $65,000 car that we got to take advantage of 100% of last year. And then on top of that, we bought another vehicle, a Cadillac XT6, and that Cadillac we were able to take advantage of a $10,000 deduction the first year and a $16,000 deduction the second year, which is 2020. Now, the difference in that, just to help you understand, and the reason why a lot of businesses go out and buy vehicles every couple years, is that I could either have taken advantage of a $16,000 deduction this year on that car, or I would have only had an $1,875 deduction for my BMW. So the difference in the tax savings actually almost paid for my entire car for this year, for this tax year. So when you understand tax law, it may be beneficial for you to go out and buy a new car. Doesn't have to be new to you, just has to be new. Now, helping you understand why you can take advantage of a vehicle and take 100% deduction off that vehicle in the first year is that businesses lobbied to Congress and they said, you know, the normal rules would take forever to be able to depreciate certain vehicles, especially things like big trucks like Mack trucks, or you know, you may have a van to run your retail store, you know, you have a truck to haul things in. So they wanted to make sure that, you know, you could take advantage of those vehicles and be able to buy those vehicles. And so you can actually legally steer away from the standard depreciation and take 100% using something called a Section 179 deduction. Now, you don't need to understand what that is, other than the fact that that is the section of the tax code that allows you to take full advantage of 100% deduction the first year that you buy a vehicle. And now there's certain vehicles that qualify, and I'll go over that in just a second. But let's say you had a $50,000 truck that you bought and you used that truck 90% of the time for business use, then you would be able to write off a $45,000 deduction in year one. Now, the only disadvantage is that if you don't have an income, a net income, in order to take advantage of the entire $45,000, but what happens is it pushes forward. So let's say that you start a business, you ended up buying this truck for $50,000 and 90% of that was used for business purposes, and after all of your expenses you were left over with $25,000 in net income. You would be able to take the $25,000 and then the rest of the other $20,000 would be pushed off to the following years. So you still get the advantage, you just don't necessarily get to claim a loss from that Section 179 deduction. Now, what is a qualified truck? And you can actually have a truck, van, or an SUV. So a qualified truck is a vehicle that's built on a truck chassis. Obviously it's a truck, and that it's new to you, that there's no rear seating, and we'll talk about that in just a second. That actually determines it to be an SUV if there's rear seating, so you can still take advantage of that. That it's at least 6 feet of cargo area, so that it's at least 6 feet of cargo area, and that you have a 6,000 gross vehicle weight. Most trucks are, but you just can actually look that up. You can Google, you know, whatever truck you want to buy, GVW, and that will tell you what the weight of that vehicle is. Now, qualified vans and SUVs, same thing. If you have let's say there's a $60,000 Cadillac Escalade, and now you would have to buy a used one in order to get that, but and you use 90% of that for business purposes, you would be able to take a $54,000 deduction in year one, yet again. So that's called bonus depreciation. So it's well above the luxury limits, as we talked about earlier. Instead of taking $10,000, you get to take, you know, the 90%, the $54,000. Now, a qualified van or SUV, again, has to be new to you. It carries passengers, so it has rear seating. So this will be a truck that has rear seating, would work out, and it's 6,000 gross vehicle weight. Now, I want to review some things with you. Most cars are depreciated over 5 or 6 years and are subject to luxury tax laws. Qualified trucks are potentially 100% tax deductible in the first year as long as they're over 6,000 gross vehicle weight. And they have that bonus depreciation that's entitled to them for that first year. So, you know, if you are in the market of buying a vehicle, you may want to consider a vehicle that's over 6,000 pounds in order to get access to these deductions. So I'm not in the market to tell people to go out and buy vehicles or spend money on expenses in order to save money in taxes, save a little bit in taxes. But what I am interested in is if it's something that you're in need of or it's something that you want, you can structure when you buy certain vehicles based upon the tax year that you have the most amount of income, and it can massively save you. So buying the two vehicles that we bought last year, the Suburban and the Cadillac, that actually ended up saving us about $30-some thousand in taxes that we would have had to pay had we not had those already. So it just makes sense sometimes. Now, here's one thing I want you to understand. Once you start treating a vehicle a certain way, you can't necessarily switch it. So if you take the standard mileage rate, you are actually allowed to change up and go to actual expenses, but you're not allowed to take actual expenses and go back to standard mileage. And the reason why is because naturally, if you have depreciated a vehicle out, then the IRS is not going to allow you to kind of double dip. Now, the exciting news is that I will share with you along the way in another chapter or unit, I will share with you how to actually take advantage of a vehicle, actually double depreciate it, which is really, really amazing. You'll love it, but we will not share that right now. That's exciting news, that you can actually write off a vehicle twice. So know that you can go from standard mileage rate to actual expenses. You cannot go from actual expenses back to standard mileage rate. And regardless of the method, whichever one you take, you need to keep track of your mileage. One of the things that you can do if you're not good at tracking your expenses is to just keep a calendar and make sure you're writing where you're going and what you're doing along the way, so that you could come back and add in those expenses. But obviously the tracking your mileage through some sort of software is going to be your best bet, so that you can make sure that you're taking advantage of all of the deductions that you're entitled to take, and you're audit proofing yourself along the way.